to the value of my house. Those seem to be the three dominant drivers of velocity. Now, the thing about pipes and the thing about stuff going in at one end and coming out the other end is there's a time lag. So next slide shows you the UK economic pipe last year. And you'll see there that last year, the amount of money going into our pipe grew by 5%. And that money was created by those major banks you see there. But the value of what came out of our pipe grew by 10%. And I'm showing you this slide because you must understand time lag. That 10% number is because in 2021, the amount going into our pipe grew by 14%. So there is a lag of up to 18 months. So I'll be showing you money supply growth today, and then that enables us to forecast over the next 18 months. But I now want you to think on a global basis. And I want you to imagine that during COVID, another China arrived on the Earth's surface. This China had $17 trillion to spend. The problem is it didn't come with any labor supply, any new raw materials, any energy. It didn't come with anything. It just came with a wallet full of 17 trillion. Well, that's exactly what has happened in the global system. All the COVID support governments around the world did, financed by new money from their central banks, created 17 trillion. Next slide, please. And this is why we have inflation. The size of the Chinese economy is 17 trillion. That money, when lockdown ended, everyone tried to buy stuff. And the global system could not absorb in real output a 14% increase in spending. In fact, the increase in spending in America was even larger, which is why we have inflation. And if we go to the next chart, you can get some sense of what's going to happen over the next 18 months. If you look at this, this is the major economies' money supply, what's going into their pipes. And globally, we need on average 6% growth in money, which is consistent with a real growth rate globally of 4 and an inflation rate of 2. And you'll see from 2019, those great big peaks in money. That money is still somewhere in the global system. Its purchasing power is being reduced by inflation, but it's out there. And that's a very important point. Now, if you look at what's happening to money supply from the end of last year and into where we are now, in the major economies, money supply is growing below 5 to 6%. In fact, the UK right now, it's 3.7. Because money supply going into our pipe is not enough to finance inflation at 10%, two things can happen. Either inflation comes down quickly or economic activity shrinks. We have a recession. Well, what is happening? Next slide, please. What is happening is the rate of inflation is beginning to fall rapidly. That doesn't mean prices are going down. It means the rate of increase in prices is slowing. And I expect this to continue throughout the year. So when Rishi Sunak said, I've got a 5% inflation target I intend to deliver, well, that target will be reached, but it'll be nothing he's done. Next slide, please. This is a good indicator. This is the cost of bringing a 40-foot container from Asia to the west coast of the States. And you can see the impact on the cost of transport when everyone's trying to buy stuff. In 2021 too, the average American tried to spend $680 billion more than usual on household stuff. And everyone, of course, wanted to supply, everyone wanted containers, and that's what happened to the price. So the price of a container is now back to pre-COVID stimulus levels. Next slide. Food price inflation. Well, we heard the news in the UK that it's running at around 17%. Well, yes, that's probably the peak where we are now, and it's highly likely the rate of increase in prices is going to fall away. I'm not sure it's going to be as sharp as that forecast, but IGD are pretty good at their forecasting. So I wouldn't go down to 2, which they have. I'd see food prices still rising this time next year, 5 to 6%. Now, the next slide is really important. This is the price of gas in Europe. And despite Brexit, we are in Europe. And you'll see that the price of gas has now dropped to the pre-Ukraine invasion level. And this is really important because it has been energy prices that have really hit households across Europe. And those energy prices should, at the end of this year, be not much higher than they were in January 22. There is a lag of 6 months before the electricity supply companies effectively pass the benefit through to us. But this significant reduction in the price of gas is a key component of my forecast. We'll come back to it later. Next slide. Now, here's the interim conclusion. If you look at global money supply growth, this shows that inflation around the world, rate of growth, the rate is going to fall significantly. America has already gone to 6%. We have a whole set of problems, which means our rate is somewhat higher. So let's go to the UK. What are our unique problems? Next slide. Well, we've got 5 unique ones. First, Brexit. Well, everyone said, well, not everyone, but I said it's going to be a very difficult thing to deal with, and so it has proved to be. Particularly the impact on investment spending by big corporates. I'll show you the data. We've had 4 prime ministers in as many years. That's one hell of an achievement. Even Italy can't do that. As you will know, we have a permanent shortage of labor. I'll take you through the demographics shortly. And we have chronic underinvestment. And if you go around the world, we have a diminished brand value. People overseas look at you slightly pityingly and say, what on earth has happened in your country? We always held you in such high esteem. Well, there we are. What are the economic consequences? Next slide. Well, the first thing is the Brexit vote killed investment spending. And you see it went flat from the day of the referendum. And then you see, of course, the big drop, which is COVID related. Investment spending on an index has only just got back to the level it was when the referendum began. And this has huge implications for productivity and for income growth. Next slide. If you don't invest, you don't get growth. And if you don't get growth, real incomes don't rise. And there you see it. If investment spending had continued at the trend established up to 2007, we would be a lot better off. In fact, if you look at that trend line, that's pretty much what America has done. That's why the average American now is a third better off than the UK. For me, it's not rocket science, and I'm sure you'll understand that you only get productivity up if you give people better tools to work with. Next slide. It's the political instability that kills investment. It's not corporation tax. It's actually not interest rates. It's companies not having a line of sight. Uncertainty is the death of investment. There you see the evidence. This is the share of GDP being spent on future growth. And that includes government spending. And you can see, well, there it is. So we aren't going to get rich for some time yet, not until investment spending increases. Okay, let's look at money supply. Next slide. We need money supply to grow between about 4 and 5% a year. And the way we do this, we manage this by raising it or lowering its price. Bank of England does that. And the whole idea is to set an interest rate now, which will get that blue line running at around 5% a year. If you look at the chart, from 2011 to 2015, the money supply was growing close to 5%, but bank lending, which is the orange line, in 2013 was actually contracting. Well, that difference is because the Bank of England was creating the money. Then it stopped doing that in 2015, and everything was running normally to 2019. Then we get COVID, and that big peak in the blue line is because of the central bank, the Bank of England. And look where we are now. That this data point is, last point is February. Bank lending has basically gone to zero. Money supply growth has actually fallen all the way back to 3.6% year on year. Why has bank lending gone to zero? Basically, it's the consequence of the trust budget and the impact it's had on long-run interest rates and mortgage demand. About 70% of the growth in money supply is mortgage lending. I do believe over the next 6 months, we'll see the orange line picking up, and I think we'll see the blue line moving back towards 5%, but there's no case to raise interest rates. And if the Bank of England does go beyond this point, I think they'll be making a mistake. Now, you might say, well, look, if that's what's going into our pipe, it's half what we need. So surely there's going to be a recession. Well, no, because things are different this time. Next slide. That chart shows you household bank accounts. And pre-COVID, the average household, if you take across the country, households in general, well, they got about 6 billion a month extra every month. That's the average. And then during COVID, with lockdowns plus furlough, household balances didn't rise by 6 billion, they rose by 27 billion. And if you add up the excess above 6 billion a month, you come to the figure of 180 billion. That has fallen back a bit in the last year because people have spent. But the point about when household A spends money, household B somewhere in the system gets it. So the money only disappears if inflation takes its value down, or banks call in loans, or central banks effectively call in loans. And that hasn't happened. I've adjusted household balances for inflation and for spending on luxury holidays in Dubai. There's still 120 billion there. And if you look at that orange line for the last few months, that is households moving money from non-interest bearing accounts into deposit accounts because they're getting a return for the first time for some years. The question is, why haven't households got rid of this money? Why haven't they spent it all? They usually do. And the answer is, a year ago, when we all heard that the average household energy bill would be up at 3,000 or 4,000 instead of 1,500, everyone, well, not everyone, but the middle classes said, well, I've got to put money away to meet this bill. I don't want to go into debt. Now, because the price of gas has gone back to pre-Ukraine levels, I believe energy bills in the last 2 quarters of this year are going to be quite a lot lower than people expected. And so they will say, oh, I've got 2 grand spare. I'll go and splash it. That's why I am much more positive than others. I think in the last 2 quarters of this year, retail sales, general spending will all be stronger than the average forecasters think. Next slide. This just shows you what happened when those energy bill numbers came out last year. In the first quarter of last year, I can tell you in January 2022, retail sales were up 10%. Never been seen before. This is volume, by the way, not value. And in February, they were up 7.3. In March, they were up 1.9. But by April, the energy bill scare was across the media. And there you see the impact. Retail sales volumes falling in every single month. Next slide. It doesn't mean people have stopped spending. It means they're getting less for their money. And it always makes me smile when you hear journalists saying, well, people really are, they've really lost confidence and you know, retail sales are well done. Well, yeah, people are spending more, but they're getting less. That's what inflation does. So there isn't a shortage of spending. It's just prices are too high. Next slide. This index is called the Purchasing Managers Index, and it's basically 8,000 purchasing managers in the UK. Excuse me. They're asked, compared to this month, will you be increasing your order rate? And any number over 50 is expansion. So there you see last year when retail sales were well ahead, people were reordering. And then by the middle of last year, they had too much stock. It just come in on a container from China or wherever. And so they cut their orders back. And now you see January, February. Well, February this year, we're up at 53, which is what we like to see. 53 is normal expansion. And I think March has come out, I think it came out yesterday, and I think that's around 52. Again, that's normal. That's good. So, next slide. We need to look at the labour market. After all, that's why you're online, I guess. And here we go. This is the demographic profile of the UK this year. I don't have time to drill you into the detail, But I'll just tell you, the net increase in the workforce this year, 330,000 plus 195 work visas. So about 500,000. And you might say, well, that's okay. Well, the problem in our country is that if you look at that, there's a bulge of people over 50. And that bulge of people over 50 is bigger than the bulge of people under 19. And so if we go ahead, before I do this, some people are saying to me, oh, well, you know, this is the post-COVID, you know, everyone's after staff, it'll all settle down. It's not going to settle down. Let's move ahead 5 years. Next slide. Oh, sorry, forgot. Let's look at where we are today. Net increase in labour supply, 525,000, but 600,000 55 to 65-year-olds have retired early. And we got 3 million people in work, but waiting for operations. So I'm not sure how good their productivity might be. And we've got currently 1.1 million advertised jobs. So net supply is roughly zero, but demand has increased by 1.1 million, which is why in Q3 earnings were up 6.6%. And we've got the most recent data, it came out yesterday, 6.7%. And this wage inflation is because there just aren't enough people around. As I promised, we're going to move ahead 5 years. Will it get any better? Next slide. Well, I'm afraid it will get worse. We don't have in here any visa applications or immigration, but if you take our homegrown, the net increase in the workforce, assuming no change in the retirement age, will be 200,000. So that's in 5 years' time. But surely it's going to be better in 10 years' time. Next slide. No, it's not. The net increase in 10 years' time is just 120,000. So there is one conclusion we draw from this, very simply, we are not going to get growth by adding people because they ain't there. So the only way we are going to get growth is through automation, artificial intelligence, getting more with the same number of people or even less. And that means the demand for engineering in the broadest definition of that term is going to be incredibly strong. Next slide. So what is the size of the UK engineer and technical workforce? Well, it's estimated to be around 438,000, of which, and this is a surprising figure, 38,000 are female. This is slightly out of date. I think it's 5 years old. But given the age profile, 25% of this 438,000 would expect to retire over the next 7 years. So not only is the overall demographic position tight, it's particularly tight for engineers and technical. And that's why every category of engineer is on the government shortage list, i.e., you can import them. Next slide. This is from the visa applications list, and very simply, you can define engineer in the broadest sense, and whatever the definition, we don't have enough, and the government's saying, yeah, we'll be granting visas, providing you're willing to pay over 24 grand, I think it is. Next slide. This is what's happened in the last 18 months. These are the visas granted. And interesting enough, for all the Brexiteers, immigration now in the UK is at record levels. It's running at 500,000. And that point is, of course, we, apart from the boats, are controlling it. So those workers and temporary workers are here because they got a visa. I don't know how many of you tried to go through this visa process. Pretty torturous and quite expensive. And I think the government really needs to sort that out to make it a lot easier. It takes a long time to get what is called A status if you're a firm, but once you have, then the process of bringing people in is in fact a lot easier. Next slide. So you may recall Liz Truss, bless her, said we are going to set a growth target of 2.5%. And to achieve this target, we're going to cut taxes by 55 billion, and we're going to borrow the money from the Bank of England. In other words, we're going to put more stimulus into a system that's already got too much money and no people. Totally moronic. Because the facts are our workforce is expanding by about 0.5%. Our productivity since 2008 is expanding by 0.5%. So that means real growth can't be better than around 1% year on year. If we want 2.5%, we've got to quadruple productivity. And this is going to require massive investment in AI and all forms of automation, which is going to require many more technical engineers than we've got. So enterprise are in a really good position. It's going to be, well, you know, if I was Aston Martin, I might be thinking, well, 10 years time, a chap called Jamie in Berkhamsted will put his name down. Anyway, next slide. The budget. Nice and boring, thank goodness. What the Chancellor has done is two really important things. Well, there's three, really. The first is this pension so-called giveaway, which will increase and is increasing the supply of consultants and GPs. The latest data is 90,000 have reapplied to the BMA to get back into doing stuff. They're people in their 50s. The childcare rollout is sensible, but it's delayed 18 months. And this last point, the 100% investment allowance, is brilliant, except for saying that it's going to probably not continue beyond 3 years. A huge mistake. They should have said it's 100% until further notice. However, it should boost investment spending, and there are signs already that it is. Next slide. The exchange rate's important because we import more than half our food. We import, when the wind's not blowing, 80% of our energy. And a 10% fall in the value of sterling against the dollar adds 1% to retail prices with a lag of about 9 months. Now, what should the exchange rate be? It should be $1.42. That's the Big Mac index. That's the price, the exchange rate that equates the price of a Big Mac in New York and London. And it was sitting a bit above that before the Brexit vote. And then you see after the Brexit vote, it pretty much fell away to 125, 128. And that's the international market saying, well, what's going to happen? Uncertainty. And then we had the Truss budget where the market said the British are deranged. but now luckily it's coming back a bit. And I think by the end of this year, we'll probably get to 126, which is still not great. I don't know if any of you been to America in the last 6 months, but the Brits say, my God, it's expensive. Well, it is when you're only getting $1.20 to the pound. If you were getting 165 to the pound, it wouldn't feel so bad. Next slide. Now, this is a bit technical, but it's important. This 30-year gilt price, and you see the pricing on the right there, is basically what drives the long run rate of interest, which guides big corporates' investment decisions. And very simply, when the price of those gilts drops, the long run rate of interest goes up. And during Boris's tenure, the markets were saying, this is all looking a bit flaky. But then when Truss came in, it was clear it really was rubbish. And the beauty of Hunt and Sunak is the markets are rewarding them by bringing the long run rate interest right the way down. And this has increased the confidence in banks because they hold a lot of this stuff on their books. And during the Truss period, some people were questioning whether banks were able to survive that, but we're through that. So no banking crisis. Don't believe the media. Next slide. This is the 10-year gilt yield, not the 30-year price. And this is the thing that drives the price of fixed rate mortgages. And you can see again in the Truss budget, it went to around 4.5, which meant fixed rate mortgage 6.5 if you could get one. The banks basically stopped doing it. But we're now back at around 3.30, and that means the fixed rate mortgage is going to be 4.8, 5.1, somewhere around there. With wages growing at 6%, despite what the media tell you, this does not mean house prices are going to collapse. Yeah, high-end house prices, over 3 million, they're a different market, but the average market is going to be flat. No price increasing this year, I think, which is good news. Next slide. Even better news, and people in my local pub still won't accept this. If you adjust the average price of a British house for inflation, it's no more expensive than it was in 2004. But since then, purchasing ability has risen by 8%. So whatever people say, young people are so in such a difficult position compared to their predecessors. They have a different lifestyle, that's for sure. But houses are not, in real terms, overpriced. Now, you try telling people that in the pub and they just won't accept it, but it's a fact. Okay, next slide. Now, I've put this in. I'm looking at the time. I'm going to deal with it very quickly. There is basically a 50-year cycle. And this 50-year cycle is basically caused by innovation. Whenever you get a spate of new innovation, you get clustering. And this creates a matrices of interconnected new lines of activity, which create above normal real growth. And so we had the cycle, it's been taken back to about 1750, and this is a best guess of what it looks like. You get below trend growth when innovation runs its course and everyone focuses on cost reduction rather than doing something new. COVID has sort of interrupted the short run development of this cycle, but we are still on the upswing. And if you look at our demographics, then we will be doing a lot more AI and tailoring products using it. So ChatGPT is just the beginning. I think the next 5 years, there's going to be a staggering change in the way stuff is done. And change always creates new. It always creates growth. Those people who say, well, it causes mass unemployment, they are just wrong. Next slide. Here are my forecasts. For the end of this year, I think our real growth rate year on year will be between 0.2 and 1. I am increasingly thinking 1 is more likely than 0.2. Our inflation rate will be 5. Earnings growth will have moderated a bit to 5%. House prices 0. I don't think the Bank of England should raise interest rates. Unemployment 3.8. So it's gone up by 0.1% in this last year. And there you see the exchange rate forecast. Now, this last point I think is important. The press is going to be full of how many businesses are ceasing trading, becoming insolvent. And they're going to portray this as a disaster. When it is a disaster for the business owner, but not for the economy. Most of these businesses that are going under are zombie businesses. They only survived because money was free. Interest rates were too low. They're not particularly efficient. They are commanding scarce resource that better run businesses could use much more efficiently. So a massive increase in insolvency should increase our productivity quite quickly. And there'll be a lot of mergers and acquisitions precisely because there will be bargain basement because of fire sales. The way I like to look at it, what's going to happen over this next 18 months is what happens when we clear out our larder of date expired tins and bottles and stuff. So it's a bit of a spring clean, and it's really good news. Next slide. So if we look at the next 10 years, that labour supply constraint is continuous, particularly in technology sectors and social care. I don't think real GDP growth can be better than 1.5% for the next 5 years until, if investment picks up, that kicks in. And it's a huge number that we need to invest. And finally, when governments say we will be reducing the size of government as a share of GDP, they are fibbing. You see, government doesn't consume as much as people think. Government consumption is 22% of GDP. That's buying tanks, building hospitals. The vast bulk of government spending is merely a transfer from young, healthy people to old, unhealthy people. So it's just a transfer of income. And because of our rapidly aging population and low growth, then government share will have to increase unless we have euthanasia, which may be a good idea. So that's what it looks like to me, and I'm willing to take any questions. I know I dumped a lot on you, but you have to look at the big picture. Thank you, Octavia, for doing the slides.
Well, thank you very much for that, Roger. Fascinating as always. We haven't had any questions in the chat, but does anyone have a question for Roger? While people are thinking of their questions, Roger, I've got a quick one. You mentioned on one of your slides that the PMI index, Purchasing Managers Index, and we've seen a bit of an uplift in the last 2 months. What's the reason for that?
Well, the reason for that is that retail sales in volume terms have actually picked up in the last 2 months. And I think what's happening is some people are already beginning to work out that the amount that they've put aside is more than required. So they are beginning to splash the cash just a bit.
Okay. And also you mentioned the gilt price has gone up, which affects investment. So are we going to see more investment from here, and are banks going to be sort of lending more? Are they going to give me a loan to get an Aston Martin?
Well, see, banks are actually very fragile institutions. They're highly leveraged, and at the moment they are not particularly inclined to lend unless you want a mortgage. If you're a growing business, they are very, very cautious, and they particularly, you need a lot of personal guarantees. You need a lot of real estate effectively to underpin your business loan. Having said that, banks' margins are actually quite thin. They're sort of like a little operation, so they've got to get volume, and their cost base has gone up by 18%, mostly because of IT costs. So banks will be driving volume. So I do expect bank lending to pick up this year, and investment as a result. But I doubt you'll get a loan for an Aston Martin. I mean, you might be in the dodgy category as far as the bank is concerned.
Great, good stuff. Okay, any more questions for Roger? Okay, well, I think we'll call it a day there then. We'll once again, thanks for attending, everyone. I hope you found that useful. We're going to send an email in the next day or two with the slides and Roger's latest economic report, and also a form where you can leave your feedback on this morning. We really appreciate that. If there's anything you'd like to discuss with us about today, the markets, or any current or future requirements, then please call or drop me or any of the team a message. And yeah, thanks very much, and thank you, Roger.
It's a pleasure.
Thank you very much, Roger. That's really interesting. Looking forward to reading the slides and trying to understand them a bit more. There's a lot in there.
There's a lot there, I know.
Excellent. Thank you very much.
We've recorded the session as well, so if you'd like to see the recording, let me know, and you can watch that back.
Perfect. Thank you so much.
Thank you.
Is everyone gone?